Hey, what's up, guys?
Hello.
Good evening. Are you guys there? Let me double check, Mario.
All
I
right.
think that we
Let's.
are. I think that we are already live. Let me see. Yeah, we should be live. I'm thinking.
Yeah, we are.
And are we live?
Yep, we
Let
are.
me
We good.
see. No live stream offline. It says Mario.
No, no, I can see you. I can see you. We
I
good.
cannot see myself. So okay, here it comes. Yeah, yeah. Okay, there you
Mhm.
go. What's up,
Perfect.
guys? How are you? Good evening. So
Hello,
let's talk
hello.
about market mechanics. What's up, Mario?
What's up, bro? How you been?
Doing pretty well, man. Crazy day out there today.
Mm-hmm.
So sorry for the delay, guys. We are starting the workshop
My bad.
20 minutes later
Mm-hmm.
than scheduled. So sorry about that.
Mm-hmm.
So what's up, Angelo, Jerry, Unrestricted, Blameless Ministries, Stefan, Micaela. Hey, Micaela, how are you? Word Child, Stefan. So, um, guys, the idea of this workshop is telling you guys about market mechanics. So, for the most part, when we are taking trades, and there are mechanical aspects of the markets that we need to take into account in order to make a decision, in order to make the best decision when it comes to starting out any given trade. So we have a bunch of mechanical indicators, or let's say market indicators that affect the way that algorithms take trades. And you guys have to keep in mind that something like 70% of the trades that we take, or 70% of the trades of the markets, are being taken through algorithms, trading algorithms. So understanding the way that these algorithms work is extremely important in order to be profitable and successful traders. So, what are your favorite market indicators, Mario, throughout the trading session?
Macro wise, I
Macro
do keep
wise, yeah,
an
sure.
yeah, I do keep. It's not about charts like macro wise. I like to keep an eye out for the US dollar,
Mhm.
the treasury yields, bond like treasury yields. I keep an
Wait,
eye out for the
hold on for a second, Mario. I have an issue
yeah.
here. So my camera isn't available. I don't know why. Let me double check on this. And
Wait, let me
sorry,
see.
yeah, I don't have my
Hmm.
camera.
So let's.
Oh yeah, I'm having an issue here, but I can switch my camera. Hold. So let me see. Yeah, sorry about this, guys. Let me see. There you go. This should work.
We got
Yeah, let me see. Okay, there you go. I am there. Yeah, this is not my favorite camera, but I am there along with you. Okay, there you go. So the problem was
all right.
solved. Was solved. Okay, go ahead, Mario. Tell me.
So I do keep an eye out for the dollar. Keep an eye out for the treasury yields, especially the short end and the long end, the
Hmm.
2 years, 10 years, and the 20. So and I do keep an eye out for the bonds as well. And this is like
Okay.
this doesn't impact me on my day-to-day trades, whatever I take. But if I'm holding long term, or if the Federal Reserve is talking, these are something to keep an eye out for, because sometimes equity markets doesn't move a lot these stuff. I can't make a bet that equity markets will move big after Federal Reserve, because anything can happen. But I do can make a bet saying that the bond markets or the treasury markets, the dollar,
Hmm.
is
Hmm.
absolutely going to move after Powell speaks, because the
Hmm.
policy decisions, whatever they make, gonna impact these sides of the markets, like the dollar. It's gonna
The
impact the
US,
currency
yeah,
markets, the
yeah.
yield mark, the
Treasury bonds,
Mhm.
correct.
Yep.
Yeah. So
So instead of that, these are certain things which I keep an eye out for on a daily basis. It always stays in my chart and my watch list, like Dixie. As I said, 10-year reels, 2-year reels, and yeah, this is something which I keep an eye out.
so the most basic market uh markets indicator, guys, would be the VIX, the volatility index. I guess that
Hmm.
most of you are familiar with the VIX, and we can tell about the VIX. I mean, we can provide to you guys further details about the VIX. So the volatility index, guys, for the most part, represents the market's forward-looking expected volatility of the S&P 500 over the coming 30 days, right?
Correct.
So
Correct.
the VIX is for the most part or entirely based on the options market of the S&P 500. So it basically uses options with more than 23 days and less than 37 days to expiration. So
Mhm.
it is basically a mirror of whatever the options market of the S&P 500 is doing. So I'm talking about call options and put options, right?
Right.
So options activity can help us to infer what the markets are going to be doing in the future. And something that we have talked about oftentimes, Mario, is that volatility is directionless. So we
Correct.
can have volatility to the upside and we can have volatility to the downside. Okay.
Mhm.
So in the case of the VIX, it has an inverse correlation to the S&P 500 of 72%. So that
Mm.
implies that um, in 72% of the time, the VIX is going to be doing the opposite that the S&P 500 does. So if you guys
Mm.
are about to start any given trade to the upside or to the downside with put options or shorting stocks, you need to keep a close watch on the VIX. Correct. I guess that's one of the most important indicators that you follow throughout the trading sessions, Mario. I don't know if you want to say something else about the VIX.
I do agree because the one thing to notice, VIX is just like helps you to plan what sort of volatility you're dealing with.
Mm-hmm.
For example, this is like a main mistake which I see a lot of beginners make. For example, if their volatility is like trade, we had the VIX stagnant at 30 for like 2 or 3 weeks continuously for a
Mm-hmm.
past few days. Those are the days where SPY were moving like 1.5 to 2% every single day. So 1 to 2% move on a daily basis, sometimes more than 2% move when you calculate the entire range of the day.
Mm-hmm.
So when VIX, the thing about VIX is volatility always reverts back to mean. What I mean by that is like when volatility goes up, the options premiums gets more expensive.
Mm-hmm.
So there is certain the volatility always reverts back to mean because the option markets can't sustain those higher values of premiums for a longer period of time, which in turn drops the VIX in the future, drops the VIX in the upcoming days. So the main issue which I see with a lot of beginner traders is they trade with the same mindset when the VIX was at 30
Mm-hmm.
as with the VIX was at 22 or 21, because like when VIX is at 30, it's pretty easy to see SPY moving from 390 to like 400 to 405 in a single day. But when VIX is actually like trading around 21, 22 or under 18 or whatever it is, 390 to 394, that's a massive range and the volatility is lower. So I even saw a lot of questions today in the morning. People were so frustrated that the SPY is just range bound between 400 and 403 for a long time. I mean, what do you expect? It's not the same volatility where what we got like a few weeks back, where like SPY was just moving between like $10 range up and down. So the volatility came down, which means the range at which the SPY is trading will also be narrower. So as more narrower the SPY trades, the more the volatility drops as well. So these two feeds off each other
Right.
because the options premiums drop when the stock price is going flat for a certain period of time, which in turn drops the VIX.
And
So
I have an interesting fact for the guys here, Mario,
mhm,
in
mhm,
order to illustrate what you just said, what you
mhm,
just stated.
mhm,
So the lower the VIX is trading at,
mhm.
that implies that the markets are expecting a, let's say, a smaller move to either the upside or the downside. So get these
Correct.
guys. The closing price of the VIX. Take a look at the VIX over here. You guys can see it, right? It
Mhm,
closed today at 24.54. What
mhm.
does this mean, guys, in practical terms? This level, this closing price of the VIX implies that the markets are expecting the S&P 500. Remember that the VIX is nothing but a mirror of the options market of the S&P 500. This implies that the markets are expecting the VIX 1 year out sorry, the markets are expecting the S&P 500 1 year out to be either 24% higher or 24% lower. So the lower the VIX goes, the smaller the expected move for the S&P 500 that is being expected. So that implies that volatility is decreasing. That's pretty much what Mario was stating over here. So this is a very important indicator. You need to keep in mind that it is inversely correlated to the S&P 500 by 72%. So you guys cannot be taking trades with either options or calls without taking a look at the VIX. And mind you guys, one of my golden rules as a trader is this one. And this is a rule that probably Mario is going to be agreeing with me to comply with, okay, to follow. I never, ever, guys, buy options if the implied volatility is above 70%. If you're about to buy an option, either a call option or a put option, and the implied volatility is above 70%, that implies that you're paying a very high premium for that option. You have to keep that in mind. So if the implied volatility of any call or any put is above 70%, you would rather to be a seller instead of a buyer. So I mean that's at least what I do. Go ahead, Mario. You have something to say here.
Yeah, so I do get your point. Like when the implied volatility is above certain percent, it's better to look for other strategies instead of buying calls or buying puts.
Like
That's
spreads.
what you're
Yeah,
trying to
for
say, right?
instance, correct. Yeah,
Yes,
absolutely.
correct. But the thing here is, the only difference is the only place where like you and I have the difference in this particular topic is every single stock. I mean, if you're talking about S&P 500, the average on SPY options is around like 14 to 19% IV, right? When the implied volatility, when the VIX is way up around 30 or 32, the highest I saw the IV in the shorter term expiration options is at around 32. 32,
Correct.
yeah, 32 in
Yeah,
IV.
but I never
So,
do near expiration
no,
options. So
no.
that's the issue. Yeah, correct.
Yeah, that is true. Yeah. So what I'm trying to say is like every single stock, since like if you come out of S&P 500, every single stock has their own average implied volatility range, right?
Correct.
Because some stock will have the average range from like 120 to like 140. That's the historic average IV. So there are several websites which actually gives you the historic implied volatility charts of the particular stocks which you're looking at. So, and there are also websites where like you can see the correlations between like they will overlap the historic implied volatility charts and then the current implied volatility charts. So if you see the current implied volatility higher than that of the historic implied volatility, which means that you're currently overpaying for your options premium.
Correct.
For example, if you wait for a while, you can get the same call option. Let's say the stock is just trading flat and then the implied volatility drops. You can get the same call options for a much, much cheaper price than it is currently trading at the moment. So this is when, as Alva said before, you can take advantage of the other strategies like credit spreads, iron condors, and what else is there?
You can sell calls if you have
Yes,
a high
sell calls,
implied
sell
volatility. You can sell
puts.
calls, which is perfect. Sell puts as well. Yeah, absolutely.
Exactly. So these are the strategies actually helps you. So I don't remember the website name exactly. By end of this session, I'll go over and I'll just send that website link in the both the chats, Chris Saints, and in my server both. I'll share it over there. So I think I don't remember if it's Trend Alpha or what's the exact website name is. That website actually gives you the charts on the current implied volatility and then also the realized volatility and then the expected implied volatility all in the same charts. And that way you can analyze the premiums on what the markets have been pricing in.
Yeah, and keep in mind, guys, that when we talk about implied volatility, the implied volatility basically refers to a metric that shows us the likelihood of changes in a given security. So
yeah, I mean, to put it simple, like that's what the market is expecting. So, for example, if you're trading a stock, you expect that stock to move to a certain extent, right? So implied volatility is nothing but the market expectations on that particular stock for the next 30 days.
Right.
Simple as that.
Exactly. Correct.
Sometimes
So
you'll get that move. If they get that move, you'll make money. Sometimes you won't get that move. Like whatever move you actually get, that's called realized volatility. What the move the market is expecting, that's called implied volatility.
volatility, correct.
So
Exactly.
when the IV is higher than that of the realized volatility and the stock didn't move as much as the market think it would have, you would lose money regardless of what strike options you got, because you overpaid for it and the market didn't move that much as the market has been expecting before.
Something that I want to point out here, guys, because I can tell that a lot of you guys like technical analysis, and drawing trend lines and stuff. In the case of the VIX, I am going to pull up a VIX chart over here. There are no buyers and no sellers. So when we are talking about the VIX, let me pull up here the VIX, and I will bring Mario back. Okay, I am going to pull up here a 4-hour chart of the VIX. I have seen this mistake over and over and over again, guys. So, and Mario knows what I am talking about. So we have sometimes, traders out there saying, okay, the VIX is approaching an important area of support. The VIX is approaching an important area of resistance. The VIX is about to make a test of the 100-day moving average. The VIX, and I need to emphasize this, is simply a mirror of the options market of the S&P 500. Nothing more, nothing less. We have no buyers here. We have no sellers here. So it is impossible to determine areas of support and resistance. Okay, so you have to keep that in mind.
It doesn't even work, like, because there's no buyers and sellers, as you said.
Correct.
What are you drawing the lines for at the end of the day? Just a mathematical equation. So,
and if you happen to be accurate, let's say calling out any given level of support, Mario, that is going to be a coincidence between a resistance, for instance, in the case of the S&P 500, relative to a support in the case of the VIX. So, I am guilty myself. Take a look. I have some lines over here, drawn in my on the 4-hour chart of the VIX. But in the case of the VIX, we cannot determine neither areas of support nor areas of resistance because there are no buyers and no sellers over here. Our friend Stefan asked, how do you find the implied volatility? That depends on the broker, bro. In the case of TD Ameritrade, you guys can see over here. We pull up Mario once again. In the case of TD Ameritrade, you can find the implied volatility at or in the options change. Okay, it is expressed percentage-wise, as you guys can see over here. In the case of Robinhood, which is another broker that I use here and there, the implied volatility is also reflected in the options change. Let me see over here, guys. Let me see UNG. Let me show you. So take a look. If you pull up the information of any option, here you can see the implied volatility. You see 100% in the case of UNG. So that is the implied volatility. Or that's a way that the implied volatility is being reflected in Robinhood. So the VIX, guys, the volatility index is a very important, let's say, mechanical indicator. So if you are about to take a long trade and the VIX is going higher, so you know that isn't the best moment to start that position. Or if you are shorting the markets, or if you are buying a put option, and the VIX is going higher, then you have a let's say a better likelihood of having an accurate entry for that trade. Anytime,
it's always
Stefan,
about
absolutely.
volatility. Like it's always about where to set your stops, what to expect from SPY. If you're trading SPY when VIX is at 30, you got to make sure to have a little bit of a wider stops. You got to make sure to go with lesser than usual contracts with the amount of contracts, whatever you buy. Let's say on 2021, when the VIX was somewhere at around 18 or 14, that was the lows in 2021, I guess, for the VIX. And you traded with 100 contracts. Yeah, that's good because the market is slowly going to melt up because we were in a bull trend. But you can't go with 100 contracts with the same stop as you went on SPY, like on 2021 when VIX was at 14, because SPY can easily move like $5 to $6 in matter of like every 1-2 hours. So yeah, so
Yeah, because
widen your
volatility
stops, lower the
is
position
is
sizing.
expanding. Yeah, absolutely.
Mhm,
That I mean that's the main subject that we want to explain
mhm,
in a very clear way
mhm,
in this live stream, guys. So if volatility expands, then you know
mhm,
that you're probably dealing with a greater move in the S&P 500, and when volatility
mhm.
goes lower, then you know that the expected move of the markets is going to be smaller.
Yep.
There you go.
So let me share something. We had an interesting question that
Yeah, go ahead.
they wanted to see
Take
what
over
happened to
take over the
Wix
screen, Mario, if
today.
you want. Yeah,
Yeah, yeah, sure. They wanted
there
to
you go.
see what happened to Wix today when the market tanked. All right, so this was the session today, technically. So we're looking at the 15-minute chart on the Wix. So as you can see, the Wix is open from 4 o'clock in the morning. 3 to 4 in the morning. After European Open, the Wix opens, the Wix futures opens. So they were just trading flat, and then something happened with Russia, and then you can literally see what happened. VIX went from 23 to 26 immediately, and you saw what happened with SPY as well.
That
It
was
went up.
that push to the upside was the PPI, Mario. Remember that we got this morning,
Uh,
correct?
nah, this one is because of the this thing at
Ah,
110
1:10
after
p.m. My
Russia.
bad,
Yeah,
my bad, my bad.
yeah,
Yeah.
yeah. This is
Okay.
after Russia. So what happened is the news came out and SPY started dropping. So before that, VIX was
Ah, that's a
dropping
VIX, bro. My
because
bad. I thought it was the S&P. My bad, my
no,
bad.
no,
Okay.
it's the VIX, it's the VIX.
You're
Yeah,
right.
yeah.
You're right. You're right.
So what happened was before that, SPY was having a range of 400 to 402. They just been consolidating, and you can see what happened with the VIX. They slowly pummeled lower. And then leading into the Russian event, like the news came out, and then like the markets just dropped from like what 402 all the way to 395.
Yep.
That's the
It's a
range.
big
And
drop,
you can
bro.
see,
Mhm.
yep, you can
That
see
was
what happened with VIX.
almost a 2% move, Mario, to the
Yep.
downside. Huge
Mhm.
move to the downside. Yep.
Yep, and the VIX completely collapsed. I mean, completely ripped to the upside. And then when the market pushed higher, when people started unloading their puts, whatever they had, once they got more clarity on that situation, you can
Mhm.
clearly see what happened later. VIX dropped all the way to where it was before, and then closed today at around 24 and 50.
Correct.
So
Stefan, so go ahead, Mario. Sorry.
yeah, good. I was just going
No.
through the questions.
Yeah,
If VIX
Stefan is
goes to
asking,
the
so
upside.
if VIX goes up, puts, and if VIX goes down, calls. I mean,
Mm, mm, mm,
yeah,
mm, mm.
and if it were perfect, if the correlation were perfect, we all would be billionaires, guys. So remember, it is inversely correlated to the indices um, in 72% of the time. But that doesn't imply that, okay, the VIX is going higher. Okay, let me get puts. Okay, the VIX is going lower. Let me get calls. I mean, it
So
just doesn't work out like that, right? Because
also one more thing
it
to
moves
have
it
keep a
moves up and
notice.
down, up and down, up and down throughout the trading session. So there are
Mhm.
other factors that you need to consider, that you need to take into account. You need to consider the areas of support and resistance. You need to take a look at the DIX, the Dixie, the US dollar that we are about to start talking about. You also need to consider yields, bonds. So this is one ingredient, very important ingredient, by the way, in the making of a successful trading session, but it isn't the only one, obviously.
Mhm. Yep. And also like if you're trading SPY, keep an eye out on SPY. Like there is you can keep an eye out for VIX, you can keep an eye out on Dixie, US 10-year. Everything helps to strengthen your bias on what you see in the SPY chart. If you're trading the SPY chart, focus on the SPY chart by keeping all these in the back of your mind. These are all secondary confirmation bias. Let's say you're long markets, you want to go long on SPY. You can take a look at VIX. You can take a look at the VIX to analyze the premiums. You can take a look at Dixie or US 10-year to see the overall sentiments around where the investors are, and then place the entry based upon the support and resistance levels of SPY instead of taking trades by looking at 10-year and then Dixie and then like VIX alone without looking at the SPY chart and with
Yeah,
just by omitting the SPY chart as a
Mario,
whole. So
take a look at my grid. This is my grid, guys. This is the grid that I
mhm,
use every single day. So what
mhm,
indicators do I have here? And I
almost.
would advise to you guys setting up your grid in a similar way to the one that I did it. I have the
Mhm,
VIX. Below the VIX, I have the 10-year Treasury yield (TNX).
mhm,
I am also taking a look at bonds. I have
mhm,
TLT
mhm,
right next to the VIX. I have the
mhm,
S&P 500 SPX, and right beside the S&P 500, I have the NDX, the Nasdaq 100, and below the Nasdaq 100, I have the Dixie. So the way that I set up my grid allows me to take a look at all of these different factors before making the decision of taking a trade.
mhm.
So that's what I am telling you guys. I
Exactly.
before taking a trade, I am not looking, I am not taking a look at one single indicator. I am following up on multiple indicators that led me, for the most part, at least uh, they allow me to have very accurate entries to my trades the vast majority of the time. Once you enter a trade, anything can happen. The markets can pull back as a whole. Uh, any bad news could come out. Um, any specific bad news about that stock, or maybe my your entry point could be uh, accurate at that exact point, but maybe the stock is right below an important moving average, and the buyers get rejected a bit after you started the trade. So anything can happen. You guys know what I'm talking about. Anything can happen whenever we start any given trade, but these factors are very important. So now I want to tell you guys about TNX. Put this down on a sticky note, guys. T as in Trey, N as in Nancy, and X. This is the 10-year Treasury yield. This is a very important indicator. Do you want to go ahead and tell the guys about TNX, Mario? What is it about?
Yeah, bro, before we move on with TNX, so just we had one question. Does
Okay.
every stock have a different VIX or VIX apply to overall stock market? All right. So the VIX only tracks the options activity on S&P 500, which is
Correct.
SPY or SPX or ES futures or whatever it is. The only SPY or SPX, the options contracts, whatever the premiums are in SPY and SPX, that's the only thing VIX tracks. So it gives you the volatility of the S&P 500, which in turn you can also make a case that all the 500 stocks which has been trading under S&P 500, if SPY is volatile, of course it's going to mean that the entire stocks which is trading under S&P 500 is also going to be volatile. So you're
Right.
not going to have Apple trading in like $1 range when the entire market is having like $10 to $15 range in a particular day. So VIX only tracks the options activity of S&P 500, not the overall markets.
Yeah, and something that is worth to point out over there is that the Nasdaq also has its
Yep,
own volatility index.
exactly.
Correct.
VXN, right?
So, yeah, but keep in mind, guys, that the S&P 500 is the most important index out there.
Mm-hmm.
So, in regular market conditions, most of the stocks out there, and this applies also for those stocks that do not trade inside the S&P 500, are going to track the S&P 500 from a market standpoint. So if we have the
Mm-hmm.
S&P 500 going on a tear, we are going to find stocks inside the Russell 2000 that don't trade inside the S&P 500 also going higher. So the
Mm-hmm.
director of the orchestra of the stock market is the S&P 500. You need to
Yep,
keep that in mind. Okay.
correct.
Do we have any other question about the VIX? The server stock has a different VIX. There you go.
Mm-hmm.
Gaetano, what's
So
up,
we just
Gaetano?
answered it. Mm-hmm.
Okay,
So
so
we may
we
have
can move
already
on
answered it.
to the TNX to the 10-year Treasury yield.
Mm-hmm. So the platform which you're using is TOS, right?
Yeah, I use Thinkorswim. Yeah, I use
All right.
Thinkorswim. Yeah, absolutely. Yeah,
Mm-hmm. Got
this
it.
is my
Mm-hmm.
grid. Mm-hmm.
All right. So let's go with TNX. Let's
10-year
begin.
Treasury yield. No, what if we go over the Dixie first, Mario? So yeah, the Dixie would
US.
be more important than TNX at least at present.
Yeah, the currency markets. Let's do it.
Correct. So the Dixie, the US dollar, guys, this is, I mean, super extremely important. You guys cannot be taking trades without following up on the DXY. Extremely important. And why? Because this is the US dollar. And why is the US dollar important, guys? Well, because 40% of the revenue that the stocks that trade, or 40% of the revenue that the companies that trade publicly here in the US stock market is being made overseas. So a very strong dollar, or the dollar going on an absolute term, obviously represents a huge problem for most of the important companies in the U.S. economy. So if we have the U.S. dollar going on a tear, that is from a mechanical standpoint, that represents an inconvenience for the S&P 500, because the earnings or the profit that these companies make um, is
Going to
affected
get affected. Yep.
in a very negative way. So this
Mhm.
is extremely important, guys. If if in on any given trading session, guys, you see the Dixie, the US dollar going higher along with the 10-year Treasury yield, and we are going to provide further details about the 10-year Treasury yield in just a second. So if these two are going higher, the markets are very likely to go lower. So go ahead, Mario, if you want to say something about the Dixie.
Yeah, so I just want to add on to whatever Alva said. Like, he just gave you the basics, but if you think about it, most of the companies which have branches all across the world bring in revenue in almost all the different currency pairs, right?
Mm-hmm.
So Dixie only tracks the US dollar, but technically how we calculate the strength of the currency is by comparing the one currency to that of the other. For example, like currency is always traded in pairs. For if you traded forex, you know this before. Like there are different pairs of currencies like USD slash pounds and USD slash yen, USD slash euro. Like there are multiple currency pairs out there. So it's not that the US dollar is particularly strong. It's just that the other currencies absolutely suck. Like they are so terribly weak compared to the US dollar, which gives the current illusion that the US dollar is so strong right now. But it's just the other currencies which are weaker because of the economic impacts which they are having in their own countries. So to come back to the point where like the importance of Dixie, so all the companies which have branches all across the world, when the currency which they are at, for example, let's say the company have a branch in UK and but the main headquarters is at US. So they actually send in revenue from UK to US. So it'll be converted into US dollars and then will be delivered it as an earnings report on an earnings call. So when their currency crashes and compared to that of the US dollar, the revenue will get affected when the amount of money which they're reporting will get affected, which in turn affects the earnings. So same goes for around all the world. When the US dollar is showing strength, which automatically means the other currencies are showing weakness compared to that of the where the US dollar is trading at. So at the end of the day, it's going to affect the earnings report of the company. And if the earnings report of the company is affected, the stock price goes lower. And if the stock price goes lower, it's going to take down S&P 500 alongside with it.
Mm-hmm.
So the market, since they're forward looking, they always price this in beforehand. That's why you see like when Dixie is up like 7 or 8% in a day, you'll see an absolute down day in SPY and QQQ because like markets are forward looking. The
So
currency markets won't be up like 7-8% in a particular day for no reason unless until there's something wrong, fundamentally wrong with the macroeconomics in the other countries and other currencies.
yeah,
So it's
and
just
something
like a flight to safety. Go ahead.
yeah, and something that is worth to be pointed out here is that the strength of the Dixie depends on the monetary policy of the Federal Reserve. So
Correct.
the main central bank of the world, or the most important central bank of the world, is our Federal Reserve, guys. We are the first economy of the world. So the Dixie, for the most part, reflects the perspective of the markets when it comes to the monetary policy of the Fed. If the
Mhm.
perception of the markets is that the monetary policy of the US is going to be tight, then the Dixie goes
Mhm.
higher. And on the other hand, if the markets believe that the that the monetary policy of the Fed is going to be, let's say, friendlier let's just put it that way, monetary wise, then the Dixie is going is very likely to go lower. So it depends.
Yep.
It is based basically upon the perception about what the Federal Reserve is going to be doing monetary wise. Okay, so
Correct.
you guys know that the one of the main actors that we have as of now in the markets is the Federal Reserve. So this is a very important component. And if you guys see, I mean, I can I see you guys taking trades every day. I see you guys talking about areas of support and resistance throughout the trading sessions. Hey, yeah, I'm taking a look at DraftKings. Take a look at Meta. Take a look at Tesla. Where is Tesla going to find any support? And none of you guys talk about the Dixie. Why? Can you can you guys please tell me why you don't um follow up on the Dixie throughout a trading session? You have to do it, guys. You have to do it.
Something to keep an eye out. Like also like stop trading every single minute. Like
Oh yeah,
we'll
I mean
come to this. We'll come to
that's
this topic
vital.
later.
Absolutely.
Yeah, we'll come to this topic later. But speaking of Dixie, important to keep an eye out for example, like you will know whether the report, whatever you got, is a good one or a bad one by looking at reaction not from the stock market, but in the reaction through dollar, through bonds, through the 10-year. You will immediately know if the report, whatever we got, is good or bad by looking at their reaction over there. Stock markets can lie. I've seen a lot of people saying that, oh, the CPI is so hot, I don't know why the market went up. Your answer is in the bond markets. Take a look at the
Mm-hmm.
US 10-year. Take a look at the TNX or US 10-year, both the same. Like take a look at the dollar. The dollar drops. Why did it drop? The 10-year drop. Why did it drop? The
Mm-hmm.
report is good. Yeah, might be a good one. So then you can go back and take a look at the report. Stock markets can push up in the opposite direction. Bond markets often, most of the time, never lies.
Yeah.
Something to keep an eye out for.
Stefan has asked me about the Dixie. That is true, Stefan. So you are the exception to the rule, bro. There you
What's he
go. That's
saying?
true. Yeah. My friend Stefan. Okay,
What
guys,
do you
keep in
say? What's
mind.
he saying?
So what's a yeah, he says he's telling me that he has asked me about the Dixie. So
Ah,
what
yeah.
yeah, what's the deal here, guys? If the Dixie is going higher, be careful because the markets might be about to dump. Obviously, this is an issue for the markets, guys. As we just told you, if the VIX is going higher, that represents an inconvenience for the markets profit wise and revenue wise, because most of the stocks of the US economy and most of the publicly traded companies in the US do business overseas. So this is something that you need to keep a close watch on every single trading session. The DIX is going higher.
And
Maybe we might be about to buy puts. The DIX is taking a dump. Okay, that sounded horrible, right? The DIX is going
kind
lower.
of.
Yeah, I take that back, guys. I take that back. Oh my god, that sounded horrible. If the
Nah,
Dixie is
so
going lower, you guys know what I meant. Okay, if the Dixie is going lower, then that's some sort of green light in order to buy calls and in order to take a trade to the upside. Okay.
mhm. So
Okay.
also one more thing. If your time frame on the trade is literally 2 minutes, so just focus on the price of the stock. If you're having long-term positions, so if you're having swing trades, if you're having trades for like 2 to 3 months out, you take a look at the chart and you find it bullish, and then you come back for a secondary confirmation, take a look at Dixie. It's at a strong support and it just bounced off higher, and then the other currency pairs are like dropping. We have a massive binary events, markets are front running something. All these uncertainties are happening. It'd be better.
Oh man, Mario needs to send me another link, guys. Yeah, hold on, bro, because yeah, the video Zoom, the call, yeah, just ended. Send me another link, bro. So stay there, guys. Mario's coming back in just a second. Send me another link, bro. Yeah. So we have a restriction here when it comes to the length of the call. So he's going to send me another he's going to send me another link. Okay. Mike Dosa is asking, so if the VIX and the DX is going down, you just say that the stocks would go up? Yeah, most likely. Yeah, most likely. That's a very good sign in order to take trades to the upside, Mike. Yeah, that's a very encouraging sign actually. I also track bonds, and we are about to tell you guys about bonds, the TLT, which happens to be 20-year Treasury bond ETF, and TNX, which happens to be the 10-year Treasury yield. Let me see if Mario sent me another link. Yeah, he must be about to do it. Okay, so yeah, those are very important indicators, guys. Very important indicators, and I mean, we are interacting throughout the training session in the main chat. I am always keeping a close watch on the Dixie, guys. And if the Dixie could also let us know who is lying, guys, when a trading session opens. I have seen this situation plenty of times, guys. So the markets gap higher as soon as the trading session opens, but we have the Dixie going higher with the 10-year Treasury yield. I know that someone is lying over there, and all of a sudden the S&P 500 or the NDX start to pull back, and I still see both the US dollar and the 10-year Treasury yield going higher. So I have a mechanical confirmation that the algorithms, because for the most part, we are talking over here about algorithms, guys, the way that algorithms react to these mechanical factors that we are telling you guys about. So if I see the indices pulling back, and I also see the Dixie and the 10-year Treasury yield going higher, or TNX, then that's a confirmation that we are about to see further downside. Let's just put it that way. Let me see if Mario's back. He should be, right? There you go. Yeah. Let me in, he says. There you go. Mario's back. Join with video. No, join without video. Come on, Mario. So, no, let me. Okay. Is he? There you go. Can you hear me, bro?
I can hear you.
And we're back, bro. So I was telling the guys, Mike was asking me about the Dixie and the VIX. If
Mhm.
these two are going higher, Mario, yeah, that's a positive sign in order to get puts from a mechanical
On.
standpoint. Not the only sign that we need to take into account, but that's a positive sign in order to short the market.
I mean,
Uh-huh.
if you look at it right now, right, like we are technically not doing much in VIX. I mean, Dixie particularly, we are in a downtrend. They are about to lose their bull trend as well. Something to keep an eye out. Like if they go up like 0.3% tomorrow or 4% tomorrow to run a test to certain numbers, yeah, it won't be reflected much. But it's like not a oracle, just like blind go get your blindfolds on and then buy puts every time you see Dixie up or whatever it is. Something to keep an eye out for, something to like be cautious about. That's what I'm trying to say.
Hey, Warchild is asking a very important question.
Mhm.
I don't have the Dixie or the VIX on
Yeah,
Robinhood.
you won't be having any of those in Robinhood.
But
You gotta go
but
to TradingView.
but they can track UUP.
Yeah, UUP tracks Dixie as an
Correct. It
ETF
tracks the
wise.
Dixie. And you can also track UVXY if you want to take a look at
Oh,
the.
bro, no, don't do that. Like
Don't do that.
UVXY
Okay,
and
okay.
VXX, it sucks. Like I've tried it before because like
Okay,
VXX and UVXY are just derivatives of VIX.
okay,
So there are days where like the VIX were up like around 4 or 5%, and VXX will be down like 4 or 5%. So
okay.
it's absolutely like not worth it. So keep an eye out for VIX and TradingView. Keep an eye out for Dixie, or UUP is pretty good, pretty accurate
It
when
isn't
tracking
leveraged, by the
Dixie.
way, which is good because when I
Yep.
said UVXY, that's a leveraged product. It is very
Mhm.
dangerous. So
Yep.
just stay away from it, okay? But in the
Exactly.
case of the Dixie, if you actually want to trade the Dixie, you can
Mhm.
trade US and ugly, and P as in Peter, UUP.
Mhm.
So that's
UUP.
that's an
Mhm.
ETF that tracks the Dixie. Correct.
Correct.
There you go.
So also like one more thing, if you're taking short-term options, especially with like right now, like they just give 1 day expiration options. Don't look at
That's
Dixie
unbelievable,
one.
Mario. I
Yeah.
cannot believe that. I mean, that's
Yes.
unbelievable. So I mean, this has been like the worst year ever, bro, for retail investors, and now we have,
1 day
options that expire.
expiration.
Yeah, 0 day to expiration every single day. So what could
So I
what could
think
possibly go wrong, bro?
I think Alva, you gotta explain a bit deeper on what type of trades you take based upon the Dixie, so people don't misunderstand and take 1 day expiration options by looking at Dixie and then like say, well, taking a look at Dixie and the wicks both were going up, so I shorted SPY, so the SPY still went up against me, but I got 1 day expiration options. What to do? So
Correct.
don't do that. Don't take one-day expiration options by looking at Dixie and UUP or what is that, Wix, and then like say that the market went against you. Always give yourself some time. Alva always goes like 3 months out with like $20-$30 in the money contracts. I don't know how he does it. So if SPY is trading at SPY
I
is
don't
trading at
gamble, bro. I don't
400,
gamble. So that's the
SPY is
reason why
going
I'm
at
not a gambler.
400. Yep, he will be like, bro, I got in the money contracts, bro. What should I do? I got 360
Yeah.
calls expiring like 3 months out. Like, all right.
I mean, 3 is like close to expiration, bro. I sometimes
Mhm.
I do 5 months out, 5 months out, 6 months out. It depends on the trade, bro.
Yep.
Let's tell the guys about TNX, the 10-year Treasury yield. So
Mhm.
very important indicator. I don't know if you want to introduce the guys to the 10-year Treasury yield, Mario.
Yep. So also the same thing, TNX, you can't find it in Robinhood. So you got to go to TradingView. You can if you're
Yeah,
using
correct.
TradingView, let me
Mhm.
share my screen.
Sure,
There are
bro. Go
two
ahead.
different ways where you can track it. So if you want to see like 24/7, you can go to US10Y. Let me show you just a minute. US10Y is the futures contracts for 10-year treasury yields. It's like 24/7 open. But if you want to track which only opens during session 9 to 4 during market hours, you can track TNX as well. So TNX is only open from 9:30 to 4 during market session. But this is like something which you can track when you're trading. But US 10-year, US 10Y is open 24/7 if you want to track everything on a real-time basis as well. Wait, what's going on? US 10Y. Yeah, there it is. So this is like the 10-year treasury yields. So it's a pretty wide topic. Albert, do you want to start with it? You can go ahead
Yeah,
and
but guys,
start what you're trying to say.
the most important thing that you need to keep in mind is that we have yields and we have bonds on the other hand, and they are inversely correlated.
Mhm.
Okay, so in the case of yields, this 10-year Treasury yield and the 2-year Treasury yield are some sort of leading indicator for the Federal Reserve. So they tell the markets what the bond market is thinking monetary wise about the path that the Federal Reserve is going to follow when it comes to hiking rates. So it is very important because, as you guys know, let's say that lower rates are very convenient for growth stocks, tech stocks, and higher multiple stocks. So the higher that yields go, that implies that let's say an important, very important number of companies out there are going to struggle, are going to have issues, are going to be struggling, and the algorithms use the 10-year treasury yield in order to either buy tech stocks, growth stocks, or higher multiple stocks, or to sell them. So if the 10-year treasury yield is going higher, then that's a very bad sign, guys. In order to start trades with Amazon, Apple, I don't know, Zoom, Arc Innovation ETF. Needless to say, non-profitable companies and stuff like that, right? So this is a very important indicator that you need to keep a close watch on, because I know that most of you guys take trades with tech oriented stocks, we can say, because I can see it, guys. You for the most part, you guys are always asking about Amazon, about DraftKings, about Tesla, about Apple, and I don't know, and so forth. You guys get the point, right? So if we have TNX, let me show you over here my grid once again. If we have the 10-year Treasury yield going higher, from a mechanical standpoint, we are very likely to see an important sector of the market being under pressure. I am talking about consumer discretionary stocks. I am talking about tech stocks. I am talking about real estate stocks, which are also inversely correlated to the 10-year Treasury yield. And on top of that, the 10-year Treasury yield is correlated for the most part with the financial sector. So if the 10-year Treasury yield is going higher in, let's say, normal market conditions, that's a good sign in order to take trades with banks. Bank of America, JP Morgan, the laundromat, the criminals of JP Morgan. Now, Maida's going, I knew that Maida was going to be laughing. So this is a very important indicator. I use it all of the time. And in the case of the 10-year Treasury yield, it has some sort of equilibrium, guys. When it trades, it closed today at 3.79%, very high. So when the 10-year Treasury yield is sitting between 2% and 2.5%, it is like neutral. So it doesn't affect the markets in a very sensitive way. But when it trades above 2.5%, above 3%, that implies that we're having an inflation issue in the markets. That implies that the Federal Reserve is going to be very aggressive monetary wise, that the Fed is probably hiking rates, because as I just told you, this is a leader indicator relative to the Federal Reserve when it comes to hiking rates. And when the 10-year Treasury yield drops below 2%, that's a whole different story. That implies that the economy is weakening, and that that we might be potentially about to enter into a recession, which is a whole different story. So I am tracking TNX during every single trading session, and before taking any trade with, as I just told you, growth stocks, higher multiple stocks, or growth-oriented stocks, I make sure that I am not going in the wrong direction when it comes to the 10-year Treasury yield. And on top of that, as I just told you, the yields are inversely correlated to bonds. And usually, when bonds go higher, here you guys can see TLT. This is a 20-year Treasury yield bond ETF. When bonds go higher, the indices follow. So we can confirm from a mechanical standpoint that any given drop in the 10-year Treasury yield is legit if we have bonds going higher in a very consistent way. Mario, your turn.
All right. So
Okay.
I want to start with what bonds are and what yields are first. And from before even going into it, from the comments, whatever we are getting, I can see that guys want people or traders. It's not just the people who are asking questions over here, but in general, the new traders, they want something like, if X happens, then Y will be the result. If Y happens, then Z will be the result. So if this happens, I'm going to do this. If this happens, I'm going to do that. If you think about it, markets doesn't work like that, especially. So we have a question here: if TNX, Dixie, and Wix works well for day trades. If you're day trading, focus on the price. Focus on the price of the stock which you're trading at. Like if you're day trading, how long do you usually do it? Like mostly like what, 5 minutes, 10 minutes?
I use 1 day, 1 minute. 1 day, 1 minute. I use.
Oh yeah, no, not the time frame. Like how long do you actually stay on the trade? Like usually, like what,
It
10,
depends.
15
It
minutes
depends
maximum?
on how accurate
Yeah.
my entry turns out to be. Yeah, sure,
Mhm.
absolutely, sure.
So like when you're day trading it, which means like technically you're scalping, you're gonna get in and out. I think that's what like you guys mean by day trade, like over here in this comment section or from the Chris Saints chat.
Mhm.
If you're using that, then like just focus on the price and don't look for shortcuts in the markets to make money, because there is none. There is nothing like if this happens, then it's easy money. Like it's, if you do this, then this. There is nothing. There is no shortcuts in the market. So you got to put in your work at the end of the day. Follow the price, keep an eye out for all these things. Now, that being said, we got to go into what bonds are and what yields are before even starting with the correlations with the markets, right? So there are two different markets. So if you guys are trading stock markets, you already know what stock markets are. You're trading it on an everyday basis. There is a completely different market. It's called fixed income.
Which
That's
is
what we,
bigger, which is larger
way
than the stock
bigger,
market. Way
way
bigger than the
bigger.
stock market.
So which is what we call bond markets. That's where the bond markets come in. We call it as also called as fixed income side of things. So until 2022, every single, if you have like a lot of money and if you let a bank and let you, or hedge fund manage your money, they call it 60-40 portfolio, where like 60% of your money will be in the stock market, 40% of your money will be in the fixed income market. So if the stock markets drop, the fixed income markets will always act as a hedge to bring you consistent income. So if the bond markets drop, the stock markets always brings you money in a consistent basis. So at least one outperforms the other, so your P&L won't be affected much. 2022 is the only year by far the 60-40 failed, where both the bond markets dropped a lot, and the stock market dropped a lot, where both are in a bear markets.
Mhm.
What do I mean by that, and why did that happen? So the bond markets work something like this. All right. So you can either buy stocks in Apple or you can buy bonds in Apple. So you can do either one of those. So when you
Those
buy
are,
bonds,
yeah,
go ahead.
those are corporate bonds because,
Exactly.
yeah, for the most part, when we talk about TLT, which is the
Mhm.
ETF that I just told you guys about, that's
That's a government bonds.
yeah,
Yep.
that's a government bond, correct?
Yep.
So,
Now I'm just
the
starting out, like just like giving them a gist
yeah, yeah,
on
yeah, sure, sure,
what
sure,
the
sure. Go
bond
ahead,
markets
sure.
are. Yeah. So it's like when you get into this bonds on Apple, what happens is, unlike shares, you'll get paid on either, like if you got like 2 year yields, your bonds mature in 2 years, and you'll get paid on an interest. Like you'll get paid the interest. That interest is what we got called yields. All right.
Correct.
So let's say you go for like 2 year bonds, and then like you'll get paid higher because the risk you're taking on a 2 year basis is higher than the risk which you're taking on a 10 year basis. You'll get paid less for a 10 year bonds than you get paid on a 2 year bonds. So how much you get paid, how much percentage you get paid is what we called as yields. So that's
Mhm.
what Alva's been talking about. 10 year yields means for the 10 year bonds, whatever you're holding, how much yields you're getting. Why? The reason why the bonds are dropping right now, because there's, for every bond you buy, there's something called as the coupon rate, right? The coupon rate is nothing but the percentage how much you're getting paid for holding that bond for a particular period of time.
Until
So
its
when the
maturity, correct?
until its maturity, correct. So when the Federal Reserve is actually raising the interest rates, when people, what they do is they will dump the previous bonds, whatever they're holding, because when the Federal Reserve is increasing the interest rates, they can get a better coupon rate in the future. For example, like let's say the yields, the 10 year yields peaked at around
Yeah,
4.341
let me add
percent.
something because when you buy a bond, the
Mhm.
yield remains fixed
Oh
until its
yeah,
maturity. Correct? Yeah,
correct.
that
Yep.
might be a bit confusing for the guys. Okay, yeah. When you
Yeah,
buy a
correct.
bond,
So
the
mhm,
yield remains fixed. Okay, that's it. So
correct.
don't deal. Correct.
Yep. So what people usually do is, if you bought like a bonds in 2020, you got paid like what? When the interest rates went to zero, the
Nothing,
10 year
Mario.
treasury is nothing actually, like around, it
Yeah.
went as low as 1.12% in
Mhm.
2020. So 1.12, not
It
even
almost it,
under
it
it.
almost went negative. Unbelievable.
Yeah, so the lowest which it went to is you'll get paid like 0.3% for the bonds what you are holding. That is like the 10 years. So when the Federal Reserve starts increasing their interest rates, the yields or the coupon rate goes up higher and higher and higher. So now the mindset of people is, I'll just sell my bonds and I'll wait for Federal Reserve to, like, peak at their interest rate. The more they raise the interest rates, the higher the coupon rates becomes. The higher the coupon rates becomes, the more you get paid on the newly purchased bonds. So what people do, they just sell all the previous bonds, whatever they were holding, waiting for Federal Reserve to like just stop raising their interest rate so they can lock in for the highest coupon rate they can as possible. So right now, what happened is yields went up and up and up and went all the way to like 4.4%. Most of the investors started looking into bonds because bonds started looking attractive at that point, because they get paid like 4.4% yield for the 10-year treasuries, whatever they're holding, 10-year bonds, whatever they're holding. So this is how bonds and treasuries work. So when you buy bond, you keep an eye out for the coupon rate, which is nothing but the yields which you're looking at, the amount of money which you get paid.
Mhm.
So when yields go up and up and up, the value of bonds go lower. When the bonds go up and up and up, the amount of money which you get paid in the yields goes lower. So that's what Alva meant by inversely correlated. All
Mhm.
right. So when yields are having a normally volatile day, it also affects the mortgage side, because you'll be paying more mortgage based upon the 10-year treasury yields. Like the mortgage rate goes up as well, and also goes up, the interest rates goes up on the loans whatever you're planning on taking in the futures as well. So the reason why it affects the growth stocks and tech stocks, like Alva is saying, is because the company is not making any money. The growth, that's the main point of growth stocks. Most of the growth stocks is not making much money.
Yeah,
They
those are
rely on the debt.
losing money companies. I am showing
Exactly.
I am showing the by the way, Mario, I am showing the guys as you're speaking
Mhm.
I am showing them a comparison between the Nasdaq 100, which is a
Mhm.
very heavily based
Tech heavy,
index.
correct. Mhm.
Okay, this is a comparison between the NDX and the 10-year Treasury yield. So take a look at these guys. The 10-year
Mhm.
Treasury yield is the purple stuff that you're seeing on this
Mhm.
chart, and you guys can see the inverse correlation. Take a look, guys. They are clearly inversely correlated. And why? Well, because higher yields and higher interest rates are very negative for most of the growth stocks or growth companies, tech companies, and higher multiple or higher multiple stocks out there. So take a look at this inverse correlation. So, and as I just told you, and Mario is telling you, if you're about to take a start any given trade with a tech stock or higher multiple stock or any stock of any given company that you know that is losing money as of now, you have to be careful if the 10-year treasury yield is going higher. And I know that many of you guys like swing trading. So if I have the 10-year treasury yield going on a tear, and we know that algorithms detect whenever the 10-year treasury yield is going higher in order to sell out of tech stocks, higher multiple stocks, and growth-oriented stocks, then if I have the 10-year treasury yield rising, I am not going to start a position in a tech stock, for instance. I am not going to be buying real estate stocks, which are also very sensitive to yields. So this is what we are talking about. Oh, this is exactly what we say when we talk about market mechanics. Go ahead, Mario, please.
Yep. So I see some questions where like, oh, I want to hear how a day trader, mediator give his thoughts on what he uses indicator. All right, guys, this stream is mainly based upon the market mechanics, not about like what indicators to use when you're day trading or like
Correct.
swing trading or all this stuff. So if you have questions about those, we will be happy to answer it in the chats. But this is mainly about the backside story, the back end of what's going on in the back end of the markets, like 10-year treasury yields, Dixie, the what, how the dollar is going to impact the markets, how the treasury yields are going to impact the markets. When people
Mhm.
say the 10-year treasury yields went up, the markets went down, what does it actually mean? So that's what we're talking about in this live stream. So if you have questions about what indicators to use in the charts when it comes to trading, we will talk about it in the chats. This is like completely different session. So we'll be happy to help you out. Shoot the questions in the
Sure.
chat. We'll help you out over there. But for
Absolutely.
now, yeah, the 10-year treasury yields, as Alva said, right? The growth companies, they need money. They need to borrow money to actually like keep on sustaining. The main reason why the markets rocketed to the upside in 2020 is because it's easy to borrow money for a
Mhm.
much cheaper interest rates. So you don't have, it was near zero when Federal Reserve did the quantitative easing, the interest rates went to near zero, which means the companies can borrow more money, which in turn helps them grow, which in turn shoots their stock prices to the upside in a crazy way. That's the main reason why in 2020 and 2021 markets keep pushing higher. Now they are tightening. Markets need to come back to reality, which means that they need to like take a step back and see like, wait, these stocks shouldn't be trading at this valuation because they are not
Mhm.
even making money. Why are
Mhm.
they trading at that valuation? Stocks like UPST, why
And
in the
rates
hell?
and rates are going higher.
Yeah,
Take a look at what
exactly.
happened today. There is another risk linked to higher rates
Mm-hmm.
and losing money companies, Mario. Take a look at what
Mm-hmm.
just happened with Carnival Cruise. They are issuing new shares in order to raise money.
Yeah.
They are diluting their shareholders.
Mm-hmm.
Why? Because if they go to the regular credit market, the rate
They're
that they are
gonna be
going to have
paying.
to pay in order to raise cash, because
Mm-hmm.
they have a huge long-term debt, is going to be very high. So
Exactly.
they rather issue new shares in order to raise money,
Mm-hmm.
obviously, in order to collect fresh new cash. So that's
Correct.
another risk that algorithms were designed in order to detect. So these trading algorithms and investing algorithms go over the balance sheet of every single stock out there. So if I have yields rising, these algorithms are very unlikely to buy shares of Carnival Cruise, of I don't know, Skills, or I don't know, Peloton, or companies that don't make any money, and that on top of that have a way larger long-term debt relative to its cash position. So take a look at
Yep.
Carnival Cruise. They are not going to be borrowing money from any given bank, Mario, with interest rates being way above, I don't know, 4 or 5%. So what are they doing? It is very simple. They are issuing new shares in order to raise money because they are in a very tough situation.
Mhm.
They have a way larger long-term debt relative to its cash position. So this is another income, a very important inconvenience when it comes to taking trades or investing in these losing money companies. That the temptation for these companies in order to dilute their shareholders is huge, obviously, because we don't have free money anymore here in the US, Mario. And we know that the Fed is going to be hiking rates until, I don't know, 4.5%, 5%. So this is
Possible.
something. This is another algorithm factor that that affects the
Yep.
way that these algorithm uh, systems trade or invest. So
Right.
this is a very important mechanical factor that you need to keep in mind, right?
Yeah, also one more thing to notice,
Mhm.
there are times where both treasury yields and Nasdaq rallied at the same time. Once the markets price in what the Federal Reserve is going to do, then the correlation starts to change. So there are times, if you go back in the same chart, what the Alba is having, you can see there are times where both the 10-year treasury yields and the Nasdaq rallied at the same time. And there are times where the 10-year treasury yields and the NASDAQ
Yeah.
fell at the same time. So like something to note is it's not something to see like the treasury yields are going down, so which means you have to long tech. The treasury yields are going up, which means you have to short tech. So it's like it is correlated until it's not. There it is much more than that, than
Yeah,
just if
it
A
is.
happens, go to B,
We
then
can
if
say,
B
Mario,
happens,
that
go to C.
the correlation is obviously very obvious, but it is imperfect. So there are some occasions in which the correlation doesn't work out perfectly well.
Exactly.
That's a point that you want to get across. And
Yeah.
the same thing applies for the VIX relative to the S&P 500. The same thing
Mhm.
applies to the Dixie relative to the S&P. So
Mhm.
they are, for the most part, inversely correlated, but that inverse correlation isn't perfect, obviously. So that's why
It
you
is
need to
like one
consider
of those
many
things
factors
where like
before
it's
taking trades.
correlated. Yep, it's correlated until it's not, sort of thing.
Hmm.
So like for example, until 2018, if you see, the bonds were inversely correlated to that of the S&P 500, where like if something goes wrong with S&P 500, people put their money in the bonds. And
Yeah,
then if everything is normal,
protection.
people just
Sure.
sell the
Yeah.
bonds. Yep, people just sell the bonds and then go
Hmm.
long in S&P 500. And then it completely changed in 2021 and 2022, where people went long on this thing. Sorry, when the yield started going up, the market started to fall, which
Sure.
means both the bond market and the stock markets are falling at the same time. So this correlation will go away once the market starts pricing in the Federal Reserve, and then we'll go back to the same situation where the stocks are up and the bonds are up at the same time and the yields are going down again. So it depends on a lot of other factors. As Albert said, the correlation is there until it doesn't.
Yeah.
So, and then you can ask, like, what's the point of this? Like, what's the point of knowing about anything if you can't predict? You can't predict the markets regardless. These are something which you need to know if you are a trader, if you are an
Hmm.
investor, if you are a market participant. You got to know the basics of the market mechanics. You got to know what it means. When you see headlines saying US 10 years treasury yields soar because this happened, you got to know what the 10-year treasury yields is and what impact does it have on the equities and why the market is falling. Same with the VIX. You can see the VIX when it's at 30 or 35. It doesn't help you buy calls or puts. It helps you pick the right strategy to use in your options contracts. Like, for example, if the VIX is at 30 or VIX is at 40 even, instead of buying calls by paying insanely expensive amount of money, you can do credit spreads, you can do debit spreads, you can do iron condors, you can do multiple other strategies in the options to take advantage of the elevated premiums. That's the point of knowing about all these. When you're taking a look at Dixie, it doesn't help you to buy calls or puts like 1 day expiration or 2 day expiration contracts or weekly
You
expiration
need to have a
contracts. It's
plan. Obviously, you need to have a plan.
exactly.
Absolutely, sure,
Mhm.
absolutely. Take a
It
look. Let's
helps you take a
reconcile,
look at the
Mario.
broader. Yeah,
Yeah,
go ahead. Go ahead. Go ahead.
let's reconcile what happened today in the markets relative to the
Hmm.
indicators that we just discussed about, right?
Hmm.
So
Yeah.
today we had the Dixie going lower,
Hmm.
going down, the S&P 500 and the major indices went higher. And
Hmm.
today we had the 10-year Treasury yield going down and the indices going higher. And mind you
Hmm.
guys, the US dollar, the Dixie, is also inversely correlated to commodities and to precious metals, obviously, because these are
Gold and silver.
denominated
Yep.
in US dollars. So
Hmm.
today we had the Dixie going lower, and guess what, guys? Crude oil went higher. So
Hmm.
what does this imply in trading terms? If I am
Hmm.
going to buy oil stocks, Exxon or I don't know Chevron or ExxonMobil or Occidental Petroleum, and I have the Dixie going higher, so that's a red flag, guys, over there. I know that the Dixie is going higher, and that is very likely from a mechanical standpoint to put downwards pressure over commodities, over oil. And if oil goes lower, then Occidental Petroleum or ExxonMobil or Chevron are very likely to follow,
Hmm.
obviously, because they track for the most part of the price of oil. And the same thing goes with gold, with silver. So these are some other, let's say, mechanical factors that you need to keep in mind. So the Dixie, the 10-year Treasury yield, and they affect many factors inside the markets. And you need to get
Exactly.
familiar with this, obviously.
So there are like many other, as you just mentioned, right? Like it's not just about S&P 500. Keeping an eye out for 10-year treasury yields opens doors for you to trade bonds, TLT, for example. You can
Correct.
trade TLT when the 10-year treasury yields is
Yeah, and by the
dropping.
way, you guys can
Mhm.
find TLT available on Robinhood, by the way. Yeah,
Exactly. Mhm.
yeah.
And
I
you can
just told
trade
you.
gold and silver. You can trade
Correct.
gold and silver when the Dixie is dropping to the upside or to the downside. If you're keeping an eye out for Dixie, Dixie is completely inversely correlated to that of the gold at almost 80% of the time. When gold is down, dollar will be up. When the dollar is down, gold will be up. So with silver. So you can trade those, any stocks which is associated with those. GLD, for example, SLV, for example, or the ETFs, which is available in the Robinhood, where you can trade the ETFs which track the gold and silver as well. So it's not just basically about, oh, if Dixie goes up, I'll buy puts on SPY. You can trade these commodities as well. Like it opens
Hmm.
doors for a wide range. So, for example, if the VIX is pushing up, you can start opening credit spreads. You can learn about credit spreads and you can do credit spreads when the VIX is higher. So, when the VIX comes down, you'll be insanely profitable in those spreads as well. So, this is the point of knowing all these things. It opens doors for multiple trades which you can take on multiple occasions on multiple different commodities. So,
And this and the stuff that we discussed about today, Mario,
mhm,
is going to let you guys to understand in a much better way the way that the markets work, obviously.
mhm,
So
correct.
there you have it. So this is very important, obviously. Do
Mhm,
you guys have any questions before we wrap it up? And by the way, guys, I'm going to ask you for a favor. Once we are done with the live stream, please go ahead and drop a comment in the regular video. I am going to be releasing this video in my YouTube channel as soon as we're done with it. And
mhm.
please just drop a comment. Let us know if you found value in this workshop and hit the like button. I am going to ask you guys for that favor. It isn't going
Uh,
to take you long.
mhm. So, like, we have one question. I mean, we'll just go over the questions before we end it. Can VIX imply that the market is risk on and risk off? No, there's other factors which you can use to determine that. VIX doesn't imply the risk on or risk off mode. The sectors where the money is flowing into does. For example, like if you see tech, financials, what other stocks, materials, all these are going up, you can clearly say that it's a risk on environment because the people are ready to put their money into risk assets like tech. And if it's a risk off, you will see money flowing into consumer staples, XLP, utilities, XLU,
Defensives,
healthcare.
correct. We
Correct.
should do
Mhm,
another. I mean, we have a bunch of we have a bunch of workshops, Mario, to do.
mhm,
To let the guys know about the sectors of the markets, to know maybe about spreads because
mhm,
they are asking about spreads,
mhm.
and yeah, so we have work to do with you guys over here, guys. We're here to help, and yeah. So if you have any last question before we wrap it up,
Yep.
Please
So
let
I
us
would like
know.
to
And
know.
remember, drop a comment down below, guys. Not here in the live chat. Just go ahead to my YouTube channel and drop a comment in the
Yep.
video itself.
hmm So
Santiago
like
Aeronautics.
to put it to end it, like I just want to say
Mhm.
there is no easy money. You got to know all these things, and all these just increases your probability of winning. At the end
Right.
of the day,
Sure.
no one knows what's going to happen. No one.
Yeah, the markets
But
are
knowing
absolutely unpredictable. But
exactly.
guys, the stuff that we just discussed about, unfortunately, I would say that, Mario, and you know you're
hmm
going to agree with me on this. So
hmm
most of the markets participant don't know this stuff, bro. I
Exactly.
know
Beginners. Yep.
people, I know a lot of people that have been dealing with the markets for years, Mario, and
hmm
they haven't heard about the Dixie, what about bonds, or about yields. So I'm like, bro, this is like driving blindfolded. So so these factors really affect the markets from a mechanical standpoint because 70% of the trading and investing that takes place out there is being carried out by algorithms. So if
Right.
you don't know this stuff, you are extremely likely to lose in either your investments or your trades. So this is very important, guys. You need to start to treat this as it is. This is serious business. You need to know a lot of stuff. This is serious business. Every time that you guys start a trade, that's your money, guys. No one give you, no one gave you that money for free. You had to work for that money. So you need to learn a lot of stuff, and you need to assume that you're dealing with serious business. That's my last
Yeah.
message to you guys.
Exactly. So if you run a restaurant, you wouldn't just like blindfoldly just follow someone else's advice and then make a dish to people who are not even aware of it, because it won't run. You won't be profitable at the end of the day. So
Right.
just like treat it as a business, as Alva said,
Yeah.
manage the risk. Don't buy 1 day expiration options, 2 day expiration options. I mean, you can make money with it. I'm talking for the beginners and beginners alone. If you're just starting to trade with options, don't even look at that 1 day or weekly or even two
No,
weeks
please
is not
stay away
enough.
from that, guys. Please stay away from that. Mario,
You
there
don't
is a
know what's
question
it
that I
doing.
always ask myself before starting a trade.
Mhm.
Did anyone give me this money for free? No, bro. This
Right.
is my money.
Mhm.
I had to sweat a lot in order to have this money available.
Mhm.
So treat this as a business, guys. Maybe we can do a Q&A maybe next week or something like that. So
Sure.
guys, I would recommend to you taking a look at this workshop once again.
Mhm.
Write down your doubts and we can do a Q&A. This is a very important matter, no doubt about it. So
Exactly.
thank you very much, Mario.
No problem.
Good work,
Appreciate it.
bro. Awesome. So
Thanks for
thank you,
having me.
guys. Please go ahead, drop a comment. Not here in the video itself. I am about to release it in my YouTube channel because this live stream has been private. Okay.
I'm
So
gonna
take care,
create like 10
guys,
accounts.
and enjoy the rest of your day. It got chilly here. You gotta be freezing over there in Connecticut, bro.
Oh, it's gonna get negative here.
Ah, okay, yeah, I am at uh how cold is it here? I don't know. I'm like a
You
42,
guys
40
use
degrees.
Fahrenheit, man. I don't know. I don't
No, no,
understand the
no. I'm speaking
terminology.
about Fahrenheit. Take care,
Yeah,
guys.
I use
See you
Celsius.
guys. Stay warm. Stay warm. Take care.